Hi there. First off, I want to thank the California Mortgage Bankers Association and Susan Milazzo for having me back this year. I'm sorry we're not all back in one room for the event, but hopefully my presentation is informative, interesting, and useful. Before I get started, I do want to mention that slides corresponding to my presentation should be available for download. A lot's changed since I shared my thoughts with all of you last year in September. What a difference a year can make. Heck, just the last 6 months. The US economy hasn't faced an impact like this in modern history. I was looking through the presentation I delivered last year, and one of the points I made was that Federal Reserve Chairman Powell would use aggressive measures to sustain the growth cycle. As the impact of the pandemic began to emerge, the Fed unleashed just about everything in its arsenal very fast and very aggressively. Congress and the president also got on board early with a comprehensive stimulus package designed to deliver a short-term economic bridge. Within just 7 weeks of the emergence of the health crisis, the Fed and Congress unlocked about 30% of our annual GDP to bolster the economy. By comparison, it took about 13 months to get something in play during the global financial crisis, and it was only about 6% of GDP. Apparently, there were lessons learned from the last recession. The Fed and Congress deployed about 5 times the resources in about 1/7 the time compared to the global financial crisis. And that has helped us sustain the economy. But it looks like the massive $7.3 trillion package delivered by the Fed and Congress won't be enough. As everyone's more than aware, the economic impact of the global health crisis has been both fast-moving and severe. I'm going to try to put some of the information we're all seeing in perspective and offer some insights on what it means for commercial real estate. In the second quarter, GDP fell by an annualized rate of 31.7%. That's a contraction of about $2.1 trillion for the quarter, roughly equivalent to the entire economy of Italy in 2019, before they got clobbered by COVID. This was the largest quarterly US economic contraction on record. To put it in perspective, the total dollar reduction in that one quarter was about 4 times more than the GDP reduction in the entire global financial crisis. And a lot of the contraction was driven by the virtual complete shutdown of the airline, hospitality, and retail sectors. Remember, consumption makes up about 2/3 of our economy, and these were the areas hit hardest. Basically, we shut off our economy for about 2 months, and it took a heavy toll, particularly on the employment market. The shutdown cost a lot of jobs. In the span of 2 months, more than 22 million employees were laid off or furloughed, basically the same number of jobs that were created in the 10-year expansion cycle. Then, as states began to reopen in May, we got a bit of a bounce, adding back just over 9 million jobs. The massive wave of job losses pushed the unemployment rate to 14.7%, significantly above the 10% unemployment peak of the global financial crisis. Over the last couple months, as states have partially reopened, unemployment has come back down to 10.2%, but that's still exceptionally high by historical standards. I need to point out, though, that the unemployment impact has not been evenly distributed. Some states have been impacted much more dramatically than others. Massachusetts and New York were hit particularly hard, with July unemployment in the 16% range. Last February, Massachusetts' unemployment rate was just 2.8%, and New York's was 3.7%. Other states in the Northeast, like New Jersey and Pennsylvania, were also hit hard. States with a heavy reliance on tourism, like Nevada, Hawaii, Florida, as well as California, also felt a big impact. Generally speaking, Midwestern states, which tend to have less density, faced a less significant level of job loss. The leisure and hospitality sector, which includes both hotels and restaurants, took the hardest hit, with 4.3 million fewer jobs in July compared to last February. But the retail sector was also severely impacted, and they're still down by 913,000 jobs. This reflects the shutdown of the retail sector and the ensuing significant decline in retail sales at the beginning of the pandemic. Core retail sales, which excludes autos and gas, fell by an unprecedented 16%. But after states started to reopen in May, sales miraculously recovered, gaining 22% between May and July. But even though total retail sales have fully recovered, the composition of those sales has structurally changed. The shutdown created some winners and losers in the retail landscape. Many businesses won't recover. Approximately 13,800 retail stores, restaurants, and businesses have closed their doors permanently. The toll has been particularly severe for retailers that were already struggling, in addition to businesses that cater to social gathering like movie theaters and gyms. The retail sectors that benefited from the shutdown include grocery stores and other necessity retailers, including Walmart, Target, and Costco, as well as e-commerce. E-commerce now constitutes 20% of total retail sales. That's up by $15.3 billion since February. To put that in perspective, e-commerce sales grew 5 times faster than normal in the last 6 months. The health crisis has really changed people's lives. It has forced the cancellation of sporting events, concerts, conventions, vacations, going to the gym, going to the movies, and so much more. But I guess if you have to find a silver lining, it would be how much money people are saving. People have been spending a lot less, and the additional savings have built up quickly, reaching more than $11.5 trillion in August. This graph has been inflation adjusted to add perspective, but savings have surged by more than $1.5 trillion since the beginning of March. This implies that once we have a medical solution in place, there could be a strong rebound in spending, and the economy could get a substantive boost. But as all that money is being put aside in bank accounts, people really aren't making any interest on it. Interest rates have fallen to their lowest level on record, with the 10-year Treasury hovering around 0.7%, near a record low. The Fed is committed to keeping interest rates down. They've indicated that they will even let inflation run hot if needed. That said, headline inflation is currently only around 1%, and core inflation, which omits food and energy, is about 1.6%. Given the Fed's target inflation rate is 2%, there's still room to work with at the moment. The main message here is that even if inflation rises, the Fed will still sustain low interest rates, at least for a while. Part of their mandate is to keep unemployment low, so they'll keep the pedal down until we see job creation revive, even if we have to contend with inflationary pressure. The low interest rates have helped fuel home buying activity, particularly new home sales. This is important right now because each home sale creates a byproduct of about $5,200 in retail sales and 1/2 of a job for a year. Each new home sale creates a ripple effect, spawning about 3 jobs for a year. So home sales will give the economy a much needed boost. Mortgage rates have tumbled to record low levels, with the 30-year mortgage rate now in the 3% range. That has spurred the pending home sales index to its highest level since 2005, which is kind of scary if you think about it. New home sales have surged to an annualized level of 901,000 units in July. To put that in perspective, sales were at 660,000 units in July last year. That's a 37% increase. Sales of existing homes have been slower, mostly because fewer people have been willing to put their home on the market while they're sheltering in place. The number of homes for sale has fallen to 4 months of supply. Back in April, there were 6.8 months of supply available. This has put upward pressure on home values. Home prices are at a record level, even on an inflation-adjusted basis, nudging out the prior peak set in October of 2005. But because mortgage rates are significantly lower now, the home payment that goes with that price point is about 30% lower than it was in 2005. But it's important to point out that the increasing pace of home purchases and the pricing escalation is about more than low mortgage rates. This is very different than the drivers that brought on the housing bubble in the mid-2000s, when so many people were speculating and flipping houses. This surge reflects both demographic drivers, millennials pushing into their 30s, as well as broader societal changes driven by the pandemic. From a commercial real estate standpoint, the low interest rates have also created some important opportunities. Naturally, refinancing activity has been up, but for investors making acquisitions, the yield premium offered by commercial real estate has rarely been better. The spread between the 10-year Treasury and the average cap rate has opened up to its second widest level on record, about 560 basis points. A few months ago, it was hard to take advantage of the low rates because so many lenders were ultra cautious and they had opened up their lending spreads to offset the perceived risk. But lender spreads have come in pretty substantively over the last couple months, and investors are getting loans. Depending on property type, location, term, loan to value, borrower strength, etc., they're getting loans in the low 3% range. Considering that the average commercial real estate cap rate has remained stable in the 6.3% range over the last few years, and we haven't seen significant movement since the onset of the pandemic, there's a healthy premium right now. Currently, cap rates offer about a 300 basis point yield spread over the cost of capital. But the window could begin to close once we have more clarity on a medical solution to the pandemic. The global health crisis has had an enormous effect on people and society. Not just the economic implication I've already mentioned, but societal changes that will be with us for years to come. This is manifested in home sales, as I mentioned, but there are broader underlying trends. Because of the pandemic, people are moving away from high-density urban core locations to suburban homes and lower-density cities. There are basically four underlying causes for the change. The first is density. Basically, physically distancing in a dense urban location is hard. People have to contend with elevators, small grocery stores, mass transit, and small living spaces. The second factor is lifestyle. People enjoy living in the urban core because of the amenities, restaurants, shops, theaters, museums, activities, etc. But all of these things are basically shut down. So the quality of life in the urban core has become far less appealing. The third cause is work-related. People are working from home, so proximity to the office has become far less important. What's more important right now is having a home office and some living space. The final major driver is demographics. The migration trend was already in play before the start of the pandemic. The millennial generation is aging. The leading edge is pushing 40 years old, and about 60% of the 72 million millennials are now in their 30s. An increasing number have been getting married and have been starting families. As a result, we were already seeing a migration to the suburbs before the onset of the pandemic, but the health crisis has accelerated the trend. It was basically the deciding factor for people who are already sitting on the fence. We can already see this trend playing out in apartment vacancy rates. In the second quarter, we saw a significant inversion. The vacancy rate of suburban apartments fell below their urban counterparts for the first time on record. The larger units, lower cost, and proximity to everyday amenities like large format grocery stores make these homes more appealing in the current climate. We're also seeing increased migration from major urban cities like New York and San Francisco to smaller cities. People leaving New York are moving regionally to Connecticut and New Jersey, but they're also migrating to more distant locations like North Carolina, Tennessee, and Florida. The Bay Area and LA are seeing migration as well, with people moving to the Pacific Northwest, Sacramento, Phoenix, and Texas. Basically, companies are letting people work from home, so a lot of people are choosing to relocate to more affordable, less dense cities. This will affect real estate markets across the country. The flow of people to the suburbs and smaller cities will cause companies to open satellite offices in low-rise office buildings in new areas. And the migration will shift demand for retail, self-storage, and even industrial facilities to new markets. This will be an important trend over the next couple of years. So, where does all this leave us as we look forward? Although things appear to have stabilized and we're seeing a bit of an economic bounce, we're not out of this yet. Barring a medical solution or a radical change in behavior, stimulus will be the most important factor. However, at least when I recorded this video, the next round of stimulus is stalled. So unless the gridlock is broken, here's what we can anticipate. The loss of the additional federal unemployment benefits at the end of July will weigh on consumption and retail sales. We'll likely see a modest impact in August because people knew this benefit would end and they likely, hopefully, save some money to cover expenses. But retail will feel a pinch if the program isn't replaced soon. The softening will likely be more visible in September and beyond. The federal unemployment benefits were injecting about $50 billion per month into the economy. That's equivalent to about 20% of last July's total retail sales. So the longer we go without replacing the unemployment benefits, the worse the drag will become. From a jobs perspective, the good news is that first-time unemployment claims have come way down from where they were back in March when we hit 6.9 million job losses in a week. First-time claims appear to have stabilized, which is good, but the bad news is that they're still at about 1 million per week, which is worse than the most severe week of the global financial crisis when the previous record was set at 665,000 first-time unemployment claims. And there's still another shoe to fall in the jobs market. The support of the last round of stimulus is waning, and we're going to see its impact. Airlines received about $25 billion of stimulus money with an agreement to not have layoffs through September. But unless something changes, the airline industry will furlough or lay off about 70,000 people in October. Other major companies that tried hard to retain staff through the pandemic are also beginning to capitulate. Several major companies in retail, tourism, entertainment, and other sectors are currently in the process of shrinking their labor force. Also, the Paycheck Protection Program money has started to burn off. As you may recall, the small business PPP loans were designed to be forgiven if at least 60% was used for payroll to retain staff for 8 weeks. Although some of that money is still out there and in play, a significant portion has already been used up, and the PPP's effectiveness in maintaining people's jobs is waning. But it's not all bad news. LinkedIn maintains a list of about 500 different companies that have a combined 1.5 million open positions right now. Companies include retailers like Amazon, Walmart, Home Depot, Albertsons, CVS, and Kroger, but they also include companies like USAA and Accenture, as well as numerous financial services companies, a variety of tech companies, healthcare companies, and more. So although there is and will be pressure on the employment market, many companies are still hiring, so the economy is not in a complete stall. There are some positives. Based on consumption numbers that have come in so far, GDP is expected to bounce in the third quarter by about 15 to 20%. That said, even if we follow that bounce with 5 to 7% growth each quarter, which are pretty optimistic numbers, we would still not get back to pre-pandemic levels until 2022. But the shape of the recovery hasn't been defined yet. We could still possibly see a V-shaped recovery, although the probability of that is getting pretty slim. Or we could face a checkmark-shaped recovery, or a U-shape, or a W-shape, or even an L-shape. Even though we're more than 6 months into this pandemic and the recession it brought with it, there are still 2 major variables. What happens with the pandemic and what happens with the stimulus? If we achieve a medical solution and inject another significant round of stimulus into the economy very soon, we could still potentially generate a V-shaped recovery. However, if it takes longer to get the pandemic under control and the gridlock stalling the stimulus package drags on, the economic revival could be very slow and bumpy. If no stimulus is passed this year and a medical solution isn't available until sometime next year, we could face an L-shaped recovery, where it's a long, slow slog back to growth. Any of these scenarios are possible. The top contender right now is probably the checkmark recovery, but like I said earlier, we're not out of the woods yet. As I move toward wrapping up, I want to focus on what all of this means for commercial real estate. The first thing is, we cannot lump all real estate together. Some sectors, like hotels and retail, took it on the chin, while industrial, for example, actually got some lift from the pandemic. Even within retail, there is significant variance. Older regional shopping malls have had a difficult time, with many tenants having declared bankruptcy, while some neighborhood shopping centers are achieving 90% or higher rent collections. And then there's the single tenant retail. The sit-down dining segment, for example, has been hit hard, while fast food with a drive-through has sustained about 70% of their sales. There are also geographic variances in play. The operating climate across the US ranges dramatically, so the real estate market in Los Angeles or New York could be very different from Dallas or Denver or Seattle or Salt Lake City. Each state, and in many cases each city, could face a very different outlook. As we entered the recession, the big question on investors' minds was rent collections, whether tenants would pay. So far, the results have been pretty promising. Industrial has been averaging about 95% collections, as have apartments. Office has been slightly off that pace, with collections in the low 90% range. Self-storage has also been in the 90% range, but many operators said that that's about normal, so that sector is not facing challenges yet. The sector facing the most difficulty is retail, where collections can range wildly depending on tenant composition, market, etc. Regional mall collections have been coming in as low as 25%, while neighborhood and community centers have been in the 75% range, although I have heard some reaching into the 90% collection range. But something I have heard frequently is that property owners have been trying very hard to work with their tenants to make it through this very challenging period, especially when the lenders provide some forbearance help. In terms of the overall performance and outlook for each property type, I'll offer a quick perspective, starting with apartments. Apartments have generally held up well so far, but could face some bumps ahead. If the expanded federal unemployment benefits are not extended at some level, rent collections will likely suffer, especially in the Class C space. The outlook will, of course, depend on employment market and the strength of the economic recovery. Household formations have slowed as a result of the recession, causing apartment absorption to taper a bit, and this is really being felt in the new construction segment. In addition, public policy like eviction moratoriums and rent control could emerge as a significant issue. The retail outlook varies greatly by property subtype, as I mentioned earlier. Some types of retail property will likely hold up well, but the sector is very vulnerable to the economy. If we manage a checkmark-shaped recovery and can get the pandemic under control, then most retail centers should recover well. The longer the pandemic persists, the worse the outlook will be. Office properties also face some segmentation. High-rise offices in the urban core face the most headwinds as physical distancing, mass transit, and logistics like elevators weigh on tenants. Although a lot of the office population is working from home, and there are many who think this is a trend that will hold, most surveys of workers and companies indicate that people still want to work at the office at least part-time. We have seen an upswing in interest in suburban office space as companies explore lower density office space options that are closer to where people are moving to. Industrial properties are outperforming as e-commerce demand strengthens. We're also seeing support coming from increased safety stock needed by local retailers and increased local cold storage demand. Industrial properties are drawing the most attention from investors right now. The last two properties I want to mention are self-storage and hotels because they're getting a lot of investor interest for completely different reasons. Self-storage actually got a little performance lift from the pandemic as students left college early and as people reconfigured their homes to accommodate a workspace. Vacancy rates came down in the second quarter and the outlook remains stable so far. Some risks are out there though, particularly if federal unemployment does not get renewed at some level. And finally, hotels, which were quite possibly the hardest hit real estate segment. Average occupancy rates fell from near record high level of 62% in February to a low of 24% in April. They have since recovered to 47%. Conference and resort destination hotels continue to face a very challenging outlook, but hotels in local drivable vacation destinations have recovered a fair amount. Again, a sector recovery is largely tied to a medical solution that will once again free people to travel by air and attend major events like conferences. In wrap-up, here are a few important considerations as the economy navigates towards recovery. First, the recovery is going to be choppy. As I mentioned earlier, there are still some major factors in play that will affect confidence levels, employment, consumption, and the real estate market. So be prepared as the economy goes through a few more gyrations through the remainder of this year. Keep your eyes on the stimulus package. What happens with unemployment benefits and small business support will be essential to maintaining operations through the fourth quarter. The stimulus will also ultimately have a significant impact on what the recovery will look like, depending on what happens with the medical solution. Expect low interest rates to remain in place. The Federal Reserve will continue to keep downward pressure on rates until we see a sustainable economic recovery forming and we see unemployment tighten back up. This will help revive commercial real estate sales as the yield premium is particularly wide right now, and that will draw investor interest. And finally, we have to remember that at its root, this is a medical issue, and a full recovery really can't take place until some sort of medical solution is in place. The economy can and will gain ground, but until people are actively flying, going to conferences in person rather than virtually, going on vacations and dining at restaurants, we cannot expect the economy to fully reignite. Thank you for sharing this time with me. I hope the information I shared was interesting and useful. Stay safe, and I look forward to seeing you all in person at the conference next year.